The banks have had a pretty good year so far. They've really traded off the lows a lot, but they're dancing to the Fed's tune. And if you're the banks, that tune's getting a little discordant, isn't it,
Little
David
discordant,
Reilly?
but it's not just a sort of good year. I mean, they've had a phenomenal year.
In terms of the stock.
In terms of the stock, yeah. I mean,
Right.
you look at Bank of America or just the big banks, they're up on average about 40% since last November, December. And you look and you're like, wow, that's a lot of love. It's actually not. What it is, it's unhate.
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 Is that a new one?
I think that's not a very elegant word, but that's really what it is. It's, you know, you think back late last year, everyone hated the big banks. Every mutual fund portfolio manager out there just did not want the words Bank of America or Citi showing up at the end of their quarter. That was, you just didn't want that. You didn't want to own them. Now I think people are feeling a bit more comfortable owning the big banks. And it's sort of like, you know, back then they were hanging from the edge of the cliff by their fingernails. Now they're sort of back up on the cliff, but what you have to remember is they're still standing pretty close to the cliff, and the reason they are is because of the Fed. Right. The super low interest rate environment is just really painful for banks, especially the biggest ones.
And what gives them the comfort to hold it now? The fact that the economy is
I
doing
think
better than
the
it
Eurozone
was?
is off the boil, so that's a big thing, because that was really knocking everything. People's attitude about where the U.S. economy is has really changed. Think back, you know, last September there was people saying, you know, oh, we're about to go into a recession. Now it's a question more of how much strength will the recovery gain. So those two things are there. And then you have, and this is to your point, the discordant note, people looking and saying, hey, next month the Fed's going to start giving some banks the green light to return capital. So that's all positives. So that's got people more comfortable, but the overall environment still isn't very supportive.
You know, it's true. When I was reading your piece, yeah, your headline is the Fed's tune. It reminded me of the famous Chuck Prince line where he says, look, when the music's playing, you got to dance.
Right.
Usually, the central banks either lowering interest rates or keeping them low is good for the banks, but it almost seems to me like it's been so long now that now you're starting to see these issues with margins.
It's not. It's actually, it's a good analogy. I wish I had thought of that. Jeez, I should have brought you in to JV with me on that. But no, it's because it's really, they can't dance because of what the Fed is doing. Because one of the things the banks have to, the biggest ones have to be so careful about is that they're ready for when the turn in interest rate happens. Because when you're talking about a trading and investment book of, you know, anywhere from 250 to 500, 600 billion, if you are, you know, sitting there out in 10-year paper and rates turn and you're not ready for that, you will just get crushed. So what the banks are having to do is keep so much of their investment just in much shorter dated paper. And that's when you look at the difference between what they pay on deposits, which is really nothing right now, but what you get, you know, look at the benchmark, the 2-year Treasury is 0.31%.
Yeah.
Well, you're not going to be going out much further, even 5 years, you know, about less than 1%. So you're just not making that much there. And that's the quandary the biggest banks find themselves in.
So with the Fed on hold, 2014 they said, right? Does that turn around at any point?
Well, it'll be interesting to see one thing that would help is if the banks start seeing more demand for loans. Because they'll have more of a spread in loan products, and then they can start lessening up a little bit on the investment. Of course, as we all know, yes, we've seen, you know, commercial lending sort of pick up a bit, but overall, most of the banks are still sort of shrinking their loan portfolios.
And tomorrow we have a JP Morgan Chase investor presentation, right? That people will be keeping a close eye on.
I think that'll be another one on the positive side of the ledger for the banks, because, I mean, you never know, though, with Jamie Dimon, because he often, you know, he's usually pretty sober in his view, and he sort of just says, here's how I see it. You think back to the third quarter, he really scared people with his talk. After the fourth quarter, he's more upbeat, so I think we'll probably hear him more upbeat Tuesday.
All right, we got to leave it there. David Reilly, thank you very much.
Thanks.